Hello everyone, hope you all are doing well. In our today's lecture, in our today's discussion, we are going to solve part A of question number 3 of SBR exam of March and June 2024 attempt. This part is of 9 marks and it is tested from accounting standard IAS 36, that is impairment of asset. So we don't need to read the complete question. We would be just focusing on exhibit 1 and we would be solving the part of this requirement, part of this question. So the question says, Jobon company is a parent company of clothing retail group and the financial year end is 31st December 2007. So we have a company that is a parent company of a group and that group pertains to clothing retail. The financial year end is 31st December 2007. The following exhibits provide information relevant to the question, and Exhibit 1 provides information about impairment of cash generating unit. It provides details of an impairment test carried out on CGU. Now the part A of this question has two subparts. The first subpart says, using Exhibit 1, explain why the cash generating unit should have been tested for impairment, and subpart 2 says discuss whether the method used to calculate the value in use and discount rate are acceptable. And this complete part A consists of 9 marks. So in the first part we need to explain that whether CGU should be tested for impairment or not, and in the second part we have to discuss that whether the methods used for calculating discount rate and value in use are correct, are acceptable or not. Alright, let's read the relevant exhibit, that is Exhibit 1. Exhibit 1 says, Jobon company is a lessee. It leases a number of commercial properties which it uses as a retail store. So it was also provided in the first line of the question that Jobon company is a parent company of a group and that group is in the business of clothing retail. So here it says that as a lessee, it obtained multiple commercial properties and those commercial properties are their retail stores. As a result of increase in customer online shopping, Jobon company's revenue from these retail stores has halved. Each retail store is a cash generating unit and comprises right to use asset, fixtures and fittings and allocated central asset. So basically it is saying that nowadays customers are going for online shopping. The trend for online shopping has increased. And as a result, the sales, the revenue from the retail stores of the company has halved. It is 50% of their routine or normal sales. Each of their retail store is a separate cash generating unit, and in each CGU there are right to use asset, that is obviously from the commercial properties. There are furniture and fixtures and there are allocated central asset which we called corporate asset as per the IAS 36 terminology. Then it says, company calculated the total impairment loss of 50 million. Company calculated that total impairment loss of 50 million should be recognized in relation to the retail store CGU. So they have themselves calculated the impairment loss, that is of 50 million. Now, the company deducted lease liabilities when calculating the net carrying amount of CGU for impairment purpose, and company assessed value in use to be the recoverable amount. Instead of deducting the lease liabilities from value in use, company included contractual lease payments within the future estimated net cash flows of the CGU. So what they have done, that in order to perform impairment testing, we have to compare the carrying amount with the recoverable amount. So while calculating the carrying amount of CGU, they deducted the lease liabilities. But while estimating or assessing the value in use, they have not deducted the lease liability. Instead, they have plotted the lease payments, the lease rentals in their future cash flows, of the CGU. And their recoverable amount is basically based on value in use. As we all know that the recoverable amount is the higher of value in use or fair value less cost to sell. So in this case, value in use appears to be on the higher side and it represents the recoverable amount. Then The future estimated net cash flows used to calculate value in use were determined using the internal management forecast covering the next 10 years. These future estimated net cash flows also included cost of $5 million to install advertising technology in the properties to enhance the CGU performance. So in this para, the value in use is calculated using the budgeted or the forecasted cash flows of 10 years. And also in the cash flows, a cost of 5 million is included, which represents anticipated or future cost to install advertising technology that will ultimately improve the CGU performance. Then it says that the future estimated net cash flows were discounted at 5%. This is the weighted average cost of capital of another company in the retail sector which purchased rather than leased its commercial properties. And the interest rate implicit in the leases was 4%. So they calculated the value in use using the discount rate of 5%, which is the weighted average cost of capital of similar company. Why similar company? Because it is operating in the retail sector. But still there is a difference. That company purchases the commercial properties, whereas our company leases the commercial properties. And the interest rate implicit in the lease is 4%, not 5%. So the first part of the first subpart of part A of this question requires us to explain whether the CGU should have been tested for impairment or not. So we all know that the accounting standard IAS 36 impairment of asset requires us to perform impairment testing on annual basis, on compulsorily annual basis for some of the assets like goodwill, intangible with indefinite useful life, intangible that is not yet available for use, or cash generating unit to which goodwill is allocated. So in case of these assets, goodwill, intangible with indefinite useful life, intangible not available for use, or CGU to which goodwill is allocated. So in case of these assets, there is a requirement to perform annual impairment testing at any cost. It is mandatory, it is compulsory for the company to perform annual impairment testing in case of these assets. But for all the other assets, company just need to assess whether there is any indicator of impairment exist or not. And that indicator can be an internal indicator of impairment or it can be an external indicator of impairment. And if there is any indicator, either internal or external, then the company is required to perform impairment testing by comparing the carrying amount and the recoverable amount. We know what is internal indicators, what are external indicators. Internal indicators means that some information we get from our internal data, from our internal reporting. Like if the performance of the asset is not what we expected, or there has been a change in the useful life, or there has been some plan to change of an asset, plan to change the use of an asset. So these are sort of internal data, internal information representing internal indicators of impairment. On the other hand, external indicators is something that we get from the external market, from the external world. Like if the market capitalization of the asset becomes lower than the carrying amount, or there has been some technological, political or other change in the society, in the environment, these could be the external impairment, external indicators of the impairment. So in this question, there has been a clear-cut explicit information that the online sales have been growing and the revenue from our retail stores have decreased. So this is sort of a clear-cut explicit external indicator that our assets have been impaired, our CGU need to be tested for impairment. So based on this discussion, we can safely conclude that yes, the impairment testing performed in this case was acceptable, was appropriate. We just read the solution to this part of the question. It says IAS 36 impairment of asset requires an entity to assess at each year end, at each reporting period, whether there is any indication that asset or cash generating unit may be impaired or not. If any such indication exists, the company should estimate the recoverable amount of the asset or CGU. And this requirement also applies to goodwill, indefinite life intangible assets and intangible assets not yet ready for use. So they are saying the same thing that we have discussed, that as per IAS 36, impairment testing is required when there is any indicator of impairment, and in that case we would compare the recoverable amount with the carrying amount. And also impairment testing is required for these assets on annual basis. Then generally internal indicators would provide reasonably direct evidence that a specific asset or CGU may be impaired. For example, internal reports might show that actual net cash flows are significantly lower than the budget. However, external source of information will more typically be broader and less clearly linked to the specific asset or CGU. For example, a decline in the market capitalization as compared to the carrying value of the entity's net asset. So basically in this para, they are just explaining what are internal indicators and what are external indicators with a single example. In this case, means in this question, there has been an increase in customer using online shopping. There has been 50% decrease in our sales from retail stores. Therefore, Jobon company was correct in the assumption that impairment review was necessary. So based on the discussion that is in the light of IAS 36 and based on the facts that is provided in the exhibit 1, it is appropriate to conclude that impairment testing is correctly performed here. Now, if we talk about the second part of this question, in which we are required to discuss whether the methods used for calculating value in use and discount rate are acceptable or not. So if we cover para by para, first in this para it is said that they have deducted the lease liabilities from the carrying value of the CGU, but they have not deducted the lease liabilities while calculating the value in use. They have plotted the lease cash flows, the lease liabilities, lease payments cash flows in the estimated future cash flows of the CGU. Now, we all know from IAS 36 as well as from our common sense that whenever we need to perform impairment testing by comparing the carrying amount and the recoverable amount, we should compare like to like. If there is a CGU which contains some assets, which contains some liabilities, and CGU is in such a form that if you decide to dispose of the CGU, then the buyer would ultimately be taking those liabilities, then we need to calculate the recoverable amount including those liabilities as well. So here, for like-to-like comparison, for accurate calculation, we should deduct the lease liabilities from the carrying value as well as from the recoverable amount as well. Now the thing is that they have plotted the lease cash flows in their future cash flows, and they have discounted those cash flows using the discount rate of 4%. Whereas interest rate implicit in the lease was 4%. They have discounted the cash flows for the calculation of value in use using the discount rate of 5%, whereas the interest rate implicit in the lease was just 4%. Now look at the logic, look at the maths behind this. We know how we calculate value in use. We plot cash inflows from the asset or CGU for number of years. In this diagram, in this example, I have just plotted 3 years. It can be more than 3 years. We plot cash outflows for using the asset for necessary cost of operating the asset in the same condition. Then we calculate the net cash flows, discount them using the appropriate discount rate, and that present value represents the value in use of the asset or the CGU. Now, we all know that present value has inverse relationship with the interest rate. Present value has inverse relationship with the interest rate. It's mean that if interest rate is increased, present value would be calculated at the lower side, and if interest rate is decreased, present value will be calculated at the higher side. So if 5% rate is used instead of 4%, it's mean present value of lease payments would have been calculated at lower side as compared to the carrying amount of lease liability. If I plot the lease payments and just discount them using the higher rate of 5%, then definitely the present value of those payments would be lower than the carrying amount of the lease liability, because carrying amount is calculated using the implicit rate, whereas for value in use calculation we have calculated the present value of lease payment using the higher rate 5%. So in the calculation of value in use, the present value of lease payment is on the lower side. Then if the present value of lease payment is on the lower side, it means that recoverable amount is on the higher side, because while calculating value in use or recoverable amount, we would have taken the present value of future cash inflows and future cash outflows. So if the cash outflows are calculated at lower side, that would ultimately mean that the recoverable amount or the value in use would have been calculated at higher side, and consequently the impairment amount would be less calculated. The asset is under impaired still, even though they have calculated the impairment of 50 million, but they have made an error in calculation of recoverable amount, and due to this logic, due to this reasoning, the value in use, the recoverable amount is on higher side. It means that asset is still under impaired, asset is still less impaired. Then it says that for calculating value in use, we have used the budgeted cash flows of 10 years. Here IAS 36 guides us that to calculate value in use, to estimate value in use, we need to take budgeted cash flows for 5 years only, not 10 years. Even IAS 36 also says that cash flows for more than 5 years can be used if we have some reasonable justification, if we have some appropriate reason, but in normal case we have to plot budgeted cash flows for the period of 5 years. Here they have used 10 years. So unless there is a proper appropriate justification, proper reason for using cash flows for more than 5 years, we cannot take cash flows for 10 years. Also IAS 36 also mandates that if we are plotting cash flows for more than 5 years, then it is necessary, it is must to use either the constant or declining growth rate for future cash flows beyond 5 years. In easy words, if we need to calculate cash flows, if we need to calculate value in use based on budgeted cash flows of more than 5 years, then we should have proper justification, proper reason for the same. And secondly, for plotting the cash flows beyond 5 years, we must use either the constant growth rate or the declining growth rate. So here, unless they have proper justification for using the 10 years budget, they cannot use the 10 years budget. They have to limit themselves to the 5-year cash flows. Then IAS 36 also guides us that while calculating the value in use, we took the cash inflows and outflows of an asset based on their existing working condition, based on their current working or performance condition. So if we are anticipating some cost that will improve the performance of the asset, we would not take that cash flows in our value in use calculation. Also, we would not only just take the cash outflow for improving the asset, for improving the performance of the asset, as well as we will also not take additional inflows from such improvement. So in order to calculate the value in use, we just plot those cash flows that can be generated from the asset in their existing condition, in their present condition, and only those outflows that are necessary to maintain those performance condition. If we are forecasting, if we are anticipating that we will incur some cost in the future, that will ultimately increase the performance of the asset, and ultimately we will generate more cash flows, then those additional or enhanced performance cash flows would not be considered, would not be accounted for while using the value in use. Then they have used the discount rate of 5% for calculating value in use, and this 5% rate is the weighted average cost of capital of similar company, but that similar company purchases the commercial properties, whereas our company leases the commercial properties. Now what IAS 36 says in this regard? IAS 36 says that discount rate is the pre-tax rate. Discount rate is the pre-tax rate that represent current market assessment of the time value of money and the risk associated with the asset or the CGU. We need to have a pre-tax discount rate that represents the current time value of money as well as the risk that are specifically part of our asset or our CGU. So using the rate of similar company whose facts are different from our company, this is not correct. This is not appropriate. Yes, we can say that since we have obtained lease at a rate of 4%, so definitely at the time of lease, the lessor would have assessed our scenario, assessed our facts. They have considered the time value of money, they have considered the risk associated with our company, and then granted us the lease at 4%. So that 4% can be used as our discount rate, can be used as our weighted average cost of capital. But the rate of 5% of similar companies whose facts are different from our company is not correct. So this is all sort of discussion that we need to do in the second part of this requirement. So let's read the suggested answer. It says, value in use. The lease payment outflow have been discounted at 5% value in use for value in use purposes, whereas interest rate implicit in the lease is 4%. Thus, lease payment outflow would be stated at lesser amount than the lease liabilities, and this would ultimately mean that value in use is higher using the company's method, which could mean that the asset is under impaired. So basically in this para, it is explaining the same thing that I have explained you through this analogy, that interest rate and present value have inverse relationship. If we use higher interest rate, present value of lease payment would be at lower side, and if present value of lease payment would be at lower side, we would have higher value in use, we would have higher recoverable amount, and if our recoverable amount is on higher side, it means asset is less impaired. So they are saying the same thing here. Then in accordance with IAS 36, it is necessary to consider liabilities to determine the recoverable amount of the CGU. This can occur if the disposal of CGU requires the buyer to assume the liability. If that is the case, carrying amount of the liability is deducted both from the CGU value in use and its carrying amount. Company has deducted lease liabilities from the carrying amount of the CGU, but has not deducted the same amount from the value in use of the CGU. Therefore, lease payment outflows should be excluded from the determination of value in use, and the carrying amount of lease liabilities should be deducted instead. So in this para, they are basically saying that for comparison, we need to compare like to like. If the CGU has some liabilities, we need to deduct those liabilities from the carrying amount as well as the value in use recoverable amount calculation. And company has not done the same thing. Then when determining value in use, IAS 36 states that projection based on budgets or forecast should cover no more than 5 years unless a longer period can be justified. Company is incorrectly using budgets for the 10-year period. Instead, IAS 36 states that cash flow beyond 5 years should be determined by extrapolating budgets using a steady or declining growth rate. So in the first instance, we have to take the budgeted cash flows for not more than 5 years. And if there is a proper reason for longer period, then we can plot 10 years. Then we can plot forecasted cash flows for 10 years. And in that case even, we are not allowed to use increasing growth rate. We can extrapolate, we can plot our budget using the steady or declining growth rate only. Then the future cash flows used to determine value in use should include estimated costs necessary to maintain the level of economic benefit expected to arise from the CGU in their current condition. They should exclude any estimated cost, that is 5 million, to enhance their performance, and estimated increase in the cash flows anticipated from enhancing its performance. Again, when we calculate value in use, we took cash inflows and outflows from the assets present working condition. If we are anticipating to incur some cost to enhance the performance of the asset, and as a result the value, the benefit, the cash flows of that asset would increase, we would not take into account those enhancement cash flows in our value in use calculation. Then it talks about discount rate. The company should not use the weighted average cost of capital of a different company in the same sector. The discount rate for value in use model must be the pre-tax rate which reflect current market assessment of the time value of money, and the risk is specific to the asset for which future cash flow estimates have not been adjusted. This would mean that company should incorporate the implicit interest rate relating to the lease liabilities. So in this para, it explains or it defines what discount rate means as per IAS 36, and that's why we should not use the WACC of the similar company. Instead, we can use the rate that is interest rate implicit in the lease, because this rate represents the current assessment of time value of money as well as risk is specific to our company, specific to the asset or CGO of our company. So this is basically the first part of question number 3 of March in 2024 attempt, and I hope I would have been able to explain this part clearly to you. Thank you for watching and see you in the next lecture.